What's going on, Trade Pros? This is Mark from Trade Pro Academy, and in today's video, I'm going to be introducing the moving average. We're going to take a look at how to use the moving averages, what they are, and how you can use them as another tool in your arsenal for technical analysis. Now, before we get into that, if you guys are new to the channel, welcome. Please take a moment to subscribe to the channel. Make sure to smash that notification bell to get notified anytime we go live or drop any videos such as this one. So I'll give you a moment to do that and we will see you shortly. All right, Trade Pros, so welcome back to the charts. What you see in front of you is my TradingView platform, and we've got a chart here of the US dollar, Canadian dollar, Forex pair on the daily time frame. All right, and so before we kind of get into the nitty gritty of this lesson, first and foremost, let's discuss what is a moving average. So a moving average is simply a type of technical indicator in this industry. In fact, it's probably one of the most commonly used indicators that we tend to see. And there's a good purpose for that, because a moving average is simply, it's a study that plots the average price over a specific period of time on your chart. What it is a mathematical formula which is calculated by averaging a number of historical data points. And since this data is smoothed over, what tends to happen, or how this helps traders, is that it helps prevent traders from getting caught in the noise of daily price fluctuations. Now, there are several types of variants to the moving average. However, in today's video, we're going to focus on the most common, which are the simple moving average and the exponential moving average. So you guys might be wondering what the difference is between the simple moving average and the exponential moving average. And that difference, in one word, is responsiveness. What you'll see here in front of you is we've got a 50-period exponential moving average here in blue, and we've also got a 50-period simple moving average here in red. So this is effectively plotting the same amount of data, 50 periods, or in this case 50 sessions. However, you can see that these two lines aren't necessarily moving in alignment with each other, and that is because of the way that they are calculated. So a calculation for the exponential moving average places more emphasis on recent data points, and as such, the EMA will generally have a higher value than the simple moving average when the market is rising, and the EMA will also tend to fall faster than the simple moving average when the market is dropping. And you can see that case in point right in front of you. If you guys are visual like myself, you'll notice here that as this market continued going higher, the blue line, which is the exponential moving average, rose faster than the red line, which is a simple moving average. And you can see at the point which the market kind of broke below these levels, you can see that the exponential moving average fell faster than the simple moving average. And that is really simply to do with the way that things are calculated. So you might be wondering, which is best for me? Well, that really depends on your style. All right. If you tend to be a bit more of an aggressive trader, the EMA, the exponential moving average, will tend to treat you better because it reacts to price faster and it can indicate potential shifts in direction sooner than the SMA. Whereas if you're more of a conservative style trader, you'd likely prefer the simple moving average. And that's because it tends to react a bit slower to price than the exponential moving average, which means that it can keep you in trends longer, and that you'll also get into trades later than the EMA, which may sometimes result in a bit less profit potential. But at the end of the day, it comes down to your own personal preference, and the best way to determine which one is best for you is to plot them both at the start and see which one works best. So which settings should you use depends on your trading style again, right? So there's a handful of common settings that are used in this industry, and they depend on whether you are more passive in your approach, as far as, you know, you can be an investor type, you can be a position trader, a swing trader, or even a day trader, right? It really depends on the length of time or the time frame of the trends you're looking to play. So a 200 EMA or a 100 EMA are going to be ideal for those traders that are more position traders that are looking to take advantage of larger term trends. They'll be using the 200 and the 100-day moving averages. If you are looking to take advantage of medium term trends such as a swing trader, the 50 moving average will be a perfect place for you to start. If you're more of a short-term swing trader, the 20 period moving average is a good place to go. And if you're a day trader, trading every single session, you can get away with a 10 period moving average. And as you can imagine, the lower the settings, the more responsive the moving average is going to be to price action. All right, so that is something for you to understand. Now that you guys are familiar with the moving average, what it is, the difference between a simple moving average and a exponential moving average, as well as the different types of settings that you can use, let's go ahead and talk about how you can use moving averages correctly. And for ourselves, moving averages generally serve two main purposes in our analysis. Number one is they tend to act as a trend filter. All right, and what that simply means is that moving averages will help us identify whether the market is in one of the three main phases. Is the market in a bull trend? All right, if the market is in a bull trend, the EMA will be rising. All right, if the market is in a bear trend, making lower lows, lower highs, the EMA will often be dropping. And if the market is directionless, if there is no trend, if there's simply consolidation, you will tend to see that the EMAs tends to be flat and the market tends to chop through, above, and below that market until there's a move that occurs. All right, and so let's clean this thing up here. Let's just get rid of that simple moving average and show you guys with an example of the 50 moving average here on the daily time frame. So trend filter, when the EMA is pointed up, all right, when the EMA is pointed up, the market direction is bullish. All right, when the market breaks below that level, all right, and starts dropping like this, when it's pointed lower, the trend direction is down. So how does this help us as traders? Well, it helps us identify the trend. And especially if you're a newer trader, you want to be trading on the side of the trend. You don't want to be doing counter trend reversals to start off with, because that is a lower probability trade. So how to use it as a trend filter? This is exactly how. If the market is above the EMA and the EMA is pointed up, you want to be looking for longs exclusively. And when the EMA is pointed down and the market is below it, you want to be looking for short opportunities only. If the market is ranging sideways and the moving average is flat, you want to stay away from that market until a trend starts to develop. Now, the second way that we like to use moving averages in our analysis is by using them as dynamic support and resistance. When you're looking at a chart, ideally you want to see a trend in the market. All right, you want to see higher highs or higher lows, or you want to see lower lows and lower highs in the context of a bear trend. And when you notice that the market starts to trend, these moving averages tend to act as really great levels that offer low risk opportunities in the form of pullbacks while the market is trending. And these pullbacks are often the result of profit taking, as well as some counter trend traders entering the market. All right, now moving averages tend to be popular counter trend fade targets during pullbacks, and they can help us identify areas within the trend that offer value. All right, and the idea here is that they are super effective when the market is trending, right? So if a market starts to consolidate and build a range, these moving averages will tend to lose relevance until we see a new trend emerge. Only once a trend begins can we start to consider moving averages as tradable levels of support and resistance. So again, we'll look back at this example of USD CAD, and you can see that as the market was moving higher, we kind of made a breakout there. We pulled back, didn't get all the way down to the moving average, but you can see we pulled back and then we continued moving on higher. The market then made a high around 1.46, pulled all the way back to the moving average here, where we did see a little bit of support before the market eventually broke back down to the downside. All right, showing us here that there was one chance for the rally to continue, two chances for the rally to continue, three chances, and then right here we had an aggressive breakout to the downside. And what that indicates to us is a potential shift in market sentiment. So that could be another way to use moving averages, is to identify market sentiment shifts. So when you see something like this, when you see a market go from bullish market to what's looking to be the start of a bearish market, you're effectively looking for pullbacks to that moving average to hold, in this case, as resistance in order to identify potential trading opportunities. So here you can see on the US CAD, nice strong breakdown. All right, the market then pulled back and you can see some wicking action here. So the market starts by making a wick rejection right around this 1.37 level. The market then kind of pulls back, forms a short-term double bottom, and then presses back up into that 50-day moving average. And you can see right around that structure here, the market taps the 50 MA, creates a little wick, which shows that there was a failure to continue through that level. And then we get another inside range formation there, and then on the next candlestick here you can see that the sellers come out, and effectively once that happens the trend starts to press lower and lower. All right, so one of the ways you can use this is once the market breaks through a level with some intent, with some good acceleration as what we saw here, then you can start looking for pullbacks and wick rejections into the moving average in order to start looking to qualify trades in the direction of the trend. In this example here, the trend had shifted because we had support, we had support, we had support. We had a strong breakdown. So this was an indication of a trend shift. Now we're looking for the market to pull back into a level of value where you can look to get short. Now, what you want to do to really add some confluence to your trading ideas when using moving averages is to utilize multi-time frame analysis. And what I mean by that is if you are looking for short opportunities, because the daily time frame shows that the market is bearish here because we are below the moving average and the moving average is pointed lower, and we can see that we did have some decent resistance here in the form of the daily time frame. So we can take this one step further by dropping down to the 4-hour time frame, and TradingView's got this really cool feature here where you can actually overlay a moving average from a different time frame. So that's exactly what I've done here. I've overlaid the daily time frame 50 moving average, and that is identified by this orange line on this 4-hour time frame. So this is the 50-day moving average, and this is the 50-period moving average here on the 4-hour chart. And going back to the example, right, the 50-day moving average retest was right over here. This is what we saw on the daily time frame. Now, when you're dropping down to the intraday time frame, what you will notice on this time frame is that the price action is still sitting relatively the moving average is relatively flat, right? So you can see in this time frame, the moving average is relatively flat, even though we held resistance on the daily time frame. So to catch the highest probability opportunities, you're going to want to wait for price action and these moving averages to align between your time frames. So in the case where the daily moving average is pointed lower, you're going to want to see price action on the intraday time frame, in this case the 4-hour. You're going to want to see a breakdown below that moving average and then a retest in order to potentially get short. All right, now that means you might have to wait a little bit longer. You might not catch the best risk to reward entry, but you are going to give yourself a higher probability of success on the trade by waiting for price action to kind of show its hand. So in this example here, what are we seeing? Well, the market's kind of rotating around here. We get that move into the 50-day moving average. The market starts to decline, but it holds this support right around this 1.35070 level. And you can see the market holds that support until we have a clean breakout from that structure. You can see at this point, price kind of separates from that intraday moving average. And that's what you want to see, because you're now waiting for the market to pull back into that moving average in order to identify your trades. So you see now how on the daily time frame we identified that breakdown, and that sellers were holding the 50-day moving average. Now dropping into the 4-hour time frame, we take it one step further by waiting for structure to shift, for that breakdown to happen, and for the retest to occur. So in this kind of a scenario, what you'd be looking for is effectively, you're looking for quick rejections into the 4-hour 50 EMA. And that's kind of exactly what we get here, right? So what you see is the market pulls up into the 50 EMA. You can see the first sign of a wick rejection here. The market then pulls back, and we get another retest of this level with, again, some wick rejections. Now, if you tend to be one of the more aggressive traders, you can simply look to put a sell stop entry right below that failed 1-hour bar or 4-hour bar here with the wick, because this right there indicates a potential failure of that wick. So a break back below that level will indicate that the sellers are back in the market. So by being patient, all right, waiting for that 50-day moving average to reject, and then waiting for the market on the 4-hour, the intraday time frame, to show you price action is aligning with the higher time frame analysis, this is going to give you the best shot at success. So there is a bit of a double top sell stop entry right down there, and that can give you a nice little ride down into previous structure. And where is previous structure? Well, on the USD CAD right now, that previous structure sits right at around 1.320, which is exactly where the market came down into before it found some short-term support, and now we're kind of right back down at that level. So that, in essence, is how you can use moving averages to really filter the trend, filter out order flow, and how you can use them as dynamic support and resistance to help increase the probability of your trades working out in your favor. All right, so there you have it, trade pros. We've discussed the moving average in great detail today, including what they are, how to use them to filter market order flow, and how to use them as dynamic supports and resistances so that you can implement these in your trading strategy. Until next time, hope you guys enjoyed this. Good luck and good trading. Take care.
Hello, and thank you for watching this video. I want to take a moment to invite you to an exclusive online trading masterclass. In this event, you're going to learn 3 key things to help take your trading to the next level. Number 1, we're going to teach you a complete price action strategy used by professional traders on a daily basis, plus give you the checklist so you know how to check off each step to qualify the opportunities. Number 2, we're going to teach you how to use advanced order flow analytics to help you qualify high probability, low risk trade setups on a daily basis. Plus, we're going to teach you how to use that order flow to disqualify the trades that you're used to taking that end up being stopped out. Number 3, we're going to show you how you can apply all of this information with a small account, because you can start small and scale up. In fact, that's the only way to start, and a lot of our traders are doing it in our community on a daily basis. This is an exclusive offer you can get online only at this event. I look forward to seeing you at this masterclass and teaching you these 3 secrets of highly profitable day trading. Take care and have a great day.